are fixed deferred annuities good or bad? And how do they stack up against CDs, money markets, and bonds? We're going to be covering that today and more. As I'm walking through my office here, you can see it's sunny. Well, it's also cold, which you probably can't tell, but it's probably about 45. And I'm just walking through my office complex, not through my office because I'm outdoors. I've got my headset on, so the mic is close to me, my mouth, and that also is nice and sunny, so you should be able to see me with no problem. But I want to look at this here. This email I received, they're asking if I recommend fixed deferred annuities. And the reason they're asking is because they stated that these fixed deferred annuities seem to be attracting a significant inflow due to rising interest rates. They're also wondering if me and other NAPFA advisors, now NAPFA is an organization for fee-only planners, in case you're wanting fee-only financial advisors. They're wondering if I recommend them and what are the pros and cons are in comparison to, as we initially stated, CDs, money markets, or bonds. Is there a type of client like retirees that I would look for these annuities? Also, who do they make most sense for? Is there an insurer that's most appealing or a maturity that's most attractive? Are retirees the target market? This is a very fascinating question, and I'll get into it. As first of all, we look at annuities, we have to understand how they're marketed. Annuities are marketed kind of like, the old-fashioned way. You go out, there's all these great, seminars and, steak dinners and all this stuff, and they get you in there, and these people are paying thousands of dollars per seminar to fund these steak dinners. And when you get invited to those things, you should know right away, hey, they're going to give me a free steak, but they got to make some sales to keep having these steak dinners and these, events that they're putting together, wine sipping things and all this other stuff. So what I want to talk about, the annuities are marketed this way. They pay big commissions on the fixed index, but these are asking about fixed deferred annuities. So these annuities they're asking about in this particular email is just about, it's kind of like, they kind of work like a CD. You put it in there for 3 to 10 years and it gets you a tax deferred interest rate. And at the end of the period, you can get all your money back plus the interest you've earned. It's all grown tax deferred. Unlike CDs where you pay interest at the end of each and every single year at your highest marginal tax rate, at your income rate, not at the dividend rate or even the long-term capital gain rate. So when you think about it, these single premium deferred annuities, the commissions they pay are not that high. So we'll go ahead and say that. I think they're probably 1.5%. It's a very, very, very competitive market. So when you buy these single premium deferred annuities, which would be, for example, let me give you an example. We're going to go and buy one from XYZ insurance company through an agent. It's a 5-year product in today's market. Let's say you're going to earn, we'll just say 4%. As here, we're talking the end of 2024. So you're going to earn 4% for 5 years. And the insurance agent, if you put in $100,000, is going to make between probably $1,000 to $2,000 if they give you one with the best interest rate, that's super competitive and that type of thing. Now, you might be able to get one that's inside of a fixed index annuity, which they're more likely to sell you. And those would probably pay like a 5 to 7% commission. And maybe they could possibly even go as high as 9, although I believe 5 to 7 is more common. I have not had my insurance license since like 2005, something like that. I haven't had it in almost 20 years. So I'm not really as up to speed on what the commissions are paying, but I do have some idea of what they're paying because sometimes I have to compare these rates against other products that we do that clients or prospects will bring on to me and have me look at these annuities. And that's kind of what the commissions are typically. So you put your money in, $100,000 will grow tax deferred at 4% for 5 years, and you'll have all that money. And when you pull it out, you'll have to pay the tax. Okay. It does appear that retirees are the kind of the target for these as often as a CD alternative. But again, I'm surprised there's a big inflow of money going into these things because they really don't pay the agents that big of a commission. I just don't think agents are recommending these things that much. So, I'm surprised that they're asking this. The thing I like about bonds is that, I've been doing this since 2000. We've never had a bond default for a client. Even the bonds that are junk bonds have only I think it's a 2% failure rate, which is for junk bonds. That's junk bonds. Investment grade it's much, much, much lower. It's like, I don't know what it is, but it's much less than 1%. So the good thing about bonds, you go into bonds, you can buy them municipal format where the interest is not taxed on the federal level. And if you buy them in your state, they're not taxed at the state level either. So it's 0% taxes or zero taxes on those. If you say, for example, live in, Alabama, and you buy an Alabama bond, no federal tax, no Alabama state tax either, state income tax. So that's pretty cool. And you can sell the bonds at any time, especially when you buy those treasury bonds. So if you buy yourself, for example, in this scenario, a 5-year treasury bond, you can go ahead and sell that baby, anytime you want. They're pretty liquid. Yeah, it's going to cost you a little bit, small premium. It's not going to be a big spread. For selling it early, you're going to have to, you're going to have to pay a little bit, but you do have the liquidity versus the annuity. I think, you can only take out 10% per year. So it's certainly less liquid for seniors and for retirees that are out there, and maybe they change their mind, they want to sell. Maybe they get sick, depending on how much money they have. So, I never like to lock up my clients in those types of, not never, I rarely like to lock up my clients in annuities. The annuities that we deal with, because I am fee only, they are liquid, and you probably haven't even ever heard of a liquid annuity if you're listening to this. They're very rare because the insurance agents don't get any commission on selling them. These are ones that we recommend to our clients and help them get into. They can get into them, one day, and then the next week they can get out of them. They don't have to stay in them for years and years and years. They don't even have to stay in them for weeks. So it's just basically like setting up a brokerage account, or an IRA or something. But annuities are fine. They're very safe. Insurance companies are probably the most financially stable financial institutions in the world. I would definitely say they're far more financially stable than banks. We saw the bank failures that we had during some of these economic downturns that we've had here in the 21st century. And the U.S. had a lot of bank failures. We didn't have any insurance company failures because they have different reserve requirements and what they have to have on reserve. So, and then I think the insurance companies are even more financially stable than brokerage companies like Fidelity and Schwab. Schwab's getting into banking. They do keep the two separate, but it's still, I think the insurance companies are probably the most safe for what we're doing and for people to invest their money in. And then here it asks, is there an insurer that's most appealing or a maturity that's most attractive? Well, no, there's not a maturity that's most attractive. It depends on what happens in the future, which nobody knows, and it depends on what fits with the investor's time horizon. I mean, do they want to be in there 3 years, 10 years, 5 years? And it's totally up to them. And then as far as the insurer goes, well, yeah, there are some insurers that are better than others. You want to look for an insurer, you want to see their AM Best rating, their Standard & Poor's ratings. I always like to do annuities that have at least an A, maybe even A+ rating. I wouldn't go below an A. If there's an A- rating on one of them, like Fitch's, and it had an A on the other two, I think that would be fine. These annuities are typically insured by the state that you live in. I believe it's up to $250,000 per annuity, so that may be another idea for you. Don't put more than $250,000 into the annuity and kind of do it like that. That's all that I have on this particular question. Subscribe to our videos. Consider subscribing to them. We'll continue to put out valuable content. I've been doing this since 2000. I'm a certified financial planner and studied finance in college as well. So we'll continue to provide videos that help you to become better stewards of the money that has been entrusted to your care.